Hey everyone, this is Dino. So today I'm going to record questions 21 to 40 for CAIB-1. I've been a little bit slow because I've been quite busy at work, a lot of hiring new hires. I've been handling like underwriters, brokers. Our brokerage is growing very fast. So one good news is that my CIP semester is coming to an end. So we have one final class next week, and then I get a break for 2 months. We close for summer, no courses to teach. So July and August, I'm just really waiting to make more videos. Okay, so just expect more videos, and I do apologize that I've been a little bit slow because I have two jobs already. Okay, excuses and excuses, right? Always excuses. Okay. All right. So questions 21 to 40, let's get right to it. So if you please subscribe, more people will receive this video. That's what I'm being told by YouTube. And if you've already subscribed, thank you so much. All right. The most basic form of coverage. Oh, okay. Stop right there. Okay. This is where they catch you. You have to see what form they're referring to in order to get the question answered correctly. Because it says here the most basic form, then immediately your mindset should be way back when, what, like a century ago, when we started talking about insurance, when homes were on fire, things like that. People are using kerosene lamps, right? So what they were most worried about? Identity theft? No. In those days, fire, right? So that's what they're talking about. So the most basic form of coverage is coverage from fire losses, okay? And so the Insurance Act in Canada also ensures there is coverage for which of the following. So if you recall, the most basic form, which is called, surprise, surprise, basic form, okay, it includes 3 coverages. That's it. Very simple. And so fire, number 1, explosion, and they qualify the explosion with some nuances, like explosion of natural, coal, or manufactured gas, any explosion due to this. So in other words, we're not referring to an explosion in a factory like a machine. No, because in those days, the Industrial Revolution has not made its advent, right? So we didn't have any all those machines blowing up. So it's only the natural coal and manufactured gas. Okay, so explosion, and we had lightning. Okay, so those are the 3. Always remember, the most basic form of coverage only had 3 coverages: fire, explosion, which can be qualified like that to make it perfect, and then lightning. Okay, so the windstorm was not there in the basic form. No, it was added when it became fire and extended care coverages. Okay, extended coverages. So we added windstorm. So it's saying what other coverages other than fire losses. So of course we have explosion and lightning, and then this is a multiple choice question, right? So you choose one of them. Then D is A and B. There you go. Okay, so D is the right answer because explosion lightning is the correct answer. I'm going to go with the D. Next question. You might have read that one of the statutory conditions is regarding misrepresentation. Absolutely, it was one of the big ones, right? Misrepresentation. This is basically the customer is not telling the truth about the risk. So when you, let's say you are an ambassador, okay, just imagine you are an ambassador of a company, of a country, and then you visit another country. Okay, what do? You represent your country. You represent because you are the face of that country. So the people in the other country, they are going to believe what you tell them, the media, your interviews and everything. So they get an idea about where you're coming from. You represent your country, what it is, okay? So what if you misrepresent your country? So you're not telling the truth about what exactly your country, how is it, and everything, right? So that's what the misrepresentation means. So which of the following statements would be considered misrepresentation? Okay, so we have to see the definition here, right? So withholding information about previous cancellations or refusals to insurance. So the key word in A is withholding. So withholding means you are hiding something on purpose. You're not disclosing something material. Let's say, for example, you made a change to your Ford F-150 and you installed a snow plow to make some money during the winter, but you're not telling that to the insurance company. You're supposed to call the insurance company. I'm making money. That they're going to change your car to a commercial car, so you don't want all that to happen. So you are withholding the fact that you install a snow plow to your Ford F-150. Okay, so it's not misrepresentation per se, but it's kind of non-disclosure, okay, withholding. So B, statements made by the applicant which lead the insurer to believe a risk is better than it actually is. Okay, I'm happy with that. Why? Because you are telling the insurance company that your house is 20 years old, okay? But in actual fact, your house is 60 years old. But there's no way for the insurance company to really, I mean, I shouldn't say there's no way, but many things that customers say on the phone, we tend to believe them. Okay. So one of them could be the age of the home. Okay. So unless we have a home inspection, that's a different question, but we can afford to have home inspection on all the homes. So here the customer is misrepresenting the home in my example, and he says it's a newer home rather than it's to say that it's an older home. So somebody, I lived in the U.S. for a while. So let's say somebody goes from Detroit, okay, and then they go to another state, and they are talking about their own state, and they're saying that Detroit is a very safe place to live because I lived there very near to Detroit in a city called Pontiac, and I know I worked in GM, so I know how structured that place now has become, Detroit. Right? But then you're saying that you're painting a good picture about Detroit. Oh, it's a nice place to live and everything. So you're misrepresenting the city of Detroit. Okay? So here he's making statements made by applicant which lead the insurer to believe a risk is better than it actually is. So I would go with B, but my suggestion is to go through all the options, okay? Because we may find a better option in C or D. So a minor error in the description of the property that is incorrect. So the keyword here is a minor. So minor error, okay, in the description of the property that is incorrect, it's not a big deal. Insurance company, they have to be very careful before they jump into conclusion, oh, you lied to us and everything. They could get into trouble for that, okay? It depends on the error. Is it a big deal? It's just a minor error, okay? Because most of the customers, if they bought an older home, they don't know much about the home, okay? They will try to do their best to give the insurance company whatever they know about it, okay? If it's minor, it's not a huge deal. So D, statements made by the applicant which lead the insurer to believe a risk is worse than it actually is. Okay, that's a funny answer, okay? Why would a customer give some bad information about a home to make the insurer believe it's worse than actually it is? That's totally preposterous, okay? So don't even take D. So I'm going to go with B. Okay, I'm very comfortable with B because that is really the textbook definition of misrepresentation. What is the objective of indemnity? First of all, we need to define indemnity. So the very basic form, a very basic definition, indemnity means bringing the customer back to the same financial position just before the loss, no more or no less. Oh, you know what? I'm actually reading option C. Okay, so this is what we keep on talking. I've been saying this from 2008, teaching these courses. So you can see C fitted exactly what I'm saying here, okay? So indemnity is just writing a check to the insured for the loss, giving him, reimbursing the insured for the loss. That's the indemnity, okay? And so the textbook definition of the return the insured here, it says, return or bring back the insured as nearly as possible to the financial position he or she was in prior to the loss, no more or no less. So what is the meaning of that? So no more means insured is put on notice, hey, don't inflate your claim. Okay, we're going to give you for whatever you lost. That's it. Don't try to inflate the claim. Don't make fraudulent claim just to make a quick buck out of this claim. Okay, no more. And no less is a cautionary note for the insurance companies. Okay, don't fall short in, we had a customer called just the other day, and they said, hey, what kind of contractors you guys have? And we said, why? What happened? No, I had a water damage in my basement, and they came and they fixed things, and then they painted the basement. And it's been just a few weeks, and the paint is coming off of the wall because probably they bought purchased the paint in the dollar store or something. These contractors. So we had to escalate it to our manager. Manager called, the company, so they're dealing with it. This is a very bad customer service. So that's why it says no less means don't give the short end of the stick to the customer. Give them, it's like, kind, and quality. You should bring them back as nearly as possible the same financial position. Okay, so that's indemnity. So allow the insured to benefit from the claim? No, we just said that. We're not going to allow him to benefit from the claim. I mean, he will get the benefit what he deserves. Okay, but that's not the objective of the indemnity. So when you say benefit, means he's not getting what he lost, but he's getting more. Okay. B, provide the full replacement cost at the time of the loss. We don't know that. Okay, maybe the policy is based on actual cash value, not necessarily replacement cost. So it's not that it's a carved in stone kind of thing that we have to provide full replacement cost at the time of the loss. Okay, it doesn't make any sense because it's just a very definitive statement, and the policy could have any kind of exclusions, or it could be on actual cash value. C, we already discussed. So this is definitely the objective of indemnity. And D is allow the insured to obtain a larger settlement. Why? With these are our laws. Why we have to give them a larger settlement? No, we already said, that's why we said no more or no less. Okay, so I'm going to go with C. Now, as I've said before, this is my own choices of answers. Okay, this is the disclaimer. Not to say that I'm going to be 100% correct. No, I will never say that I'm going to be 100% correct, because I just don't know everything. Okay, but I'm going to do my best. So if you have some of the text that you read and my answer cannot be right, then go with that. Okay, go with your instinct. Okay, that's my suggestion. Okay, what must the insured have in the subject matter of insurance before they can be indemnified for a loss? Okay, so some of the words we have to nuance it. Okay, we have to define it. What must the insured have in the subject matter of insurance? What do we mean by subject matter of insurance? That means what is being insured. It could be a car, home, a business. So what is being insured? That is called in the industry subject matter of insurance. Okay, so let's say this in this question, the customer is insuring a home. So we can now rephrase it like, what must the insured have in the home, okay, before they can be indemnified for a loss, before they can make a claim and get reimbursement? What must the insured have? I mean, this is a tough question. I should say that. Okay, so you may be lost sometimes. What do you mean what the insured should have? Okay, of course this is a very deeper question. It goes into what I would call is the heart and soul of insurance, the heart and soul of insurance, for lack of a better expression. Okay, I'll explain to you in a moment why I say that. So fundamentally, the insured should own the property. The insured should have an interest in the property. How do they have an interest? Let me give you an example. So let's say your neighbor had a water damage in his basement, and he's running around, and you came to know about it. You just go there and you try to help him out. but you are not affected, right? You're not directly affected. You may help out and everything, that's it. So because your friend's house had a water damage and you're not directly being affected, you don't have an interest in that house. You don't have, in fact, you don't have an insurable interest in that house. So let's say you had a water damage in your own basement, and then you are now, your day's ruined. You have to take care of the claim, and you have to wait for the contractor to arrive. You cannot even get to work. So you are put under so much of trouble here, okay? That means you own that property. When something goes wrong with the property, you are immediately affected. Okay, so that means you have insurable interest. Why did you purchase insurance? Because something will happen like this. That's why you purchase insurance. Because you don't want your property to be destroyed or whatever. So because you own it and you care for it. Okay, so that means you have to be the owner, or you should have insurable interest before you can make a claim and get indemnified. Okay, so that is the answer to that. So the first one is the utmost good faith. Well, it's a good concept, it sounds good, moral connotation and everything, but it's not, to be indemnified. Yes, you should have utmost good faith. You should tell the truth to the insurance company always. Yeah, it's one of the criteria, but it's not that this is what you should have, utmost good faith to be indemnified. No. Okay. Insurable interest, absolutely yes. Okay. You must have insurable interest. That means you have to own the property to make a claim and get indemnified. So indemnity is bringing the insured back to the same financial position we talked about in the previous question. Okay. This is not talking about what should you have in the subject matter of insurance to get indemnified. Okay. Indemnity is talking about the concept of reimbursing and everything. Agreement, no, it doesn't make any sense. Okay, agreement is just to get there's an offer and an acceptance. Somebody's selling something, so there's an agreement. It's just one of the elements of the contract. Okay, that's it. So it's nothing to do with indemnified. So I'm going to go with B, insurable interest. Okay. Okay. Which statutory condition below is untrue? So you got to be very careful when reading the question. It says untrue because we always look for the right answer, but in this case we have to look for the wrong answer. Okay, which is untrue. So insurers only have an obligation to those parties named on the declaration page and have insurable interest. Okay. So this is true. We're not saying it. I'm reading it again because remember, it's confusing because it's asking for untrue. So I want to make sure I'm finding the wrong answer here. So this is actually A is true because if somebody is insuring their property, their name should be there on the declaration page. Declaration page means the first page of a policy. It has the name of the insured, name of the insurance company, what's being insured, the subject matter, the premium, and all those amounts and everything. So yeah, we need to have the name of the parties. Why it's a party? Because it could be the customer owning the house, and there could be a mortgagee, like a bank where he took the mortgage, and their name should be also on the declaration page because they also have an insurable interest. Okay, so there's nothing wrong with that. Okay, it's not untrue. B, a material change in the is a change that alters the risk in a way that increases potential for loss. That is absolutely correct. The word material is being used in our industry to signify something is very important, something very significant. That's what the word material means. Okay, so that means somebody started a business in their basement. A lot of people are doing that after COVID. Okay, so if you happen to talk to a customer, just ask them, Mr. Customer, did you start any business? And 80% of the people are responding, yes, I did. That's what the numbers say. Okay. Because a lot of people are working from home. So anyway, that would be starting a business in your basement would be considered a material change. Okay. You must call the insurance company even before you start the business. Okay. The customer should call so because not all the businesses running from home are acceptable by the insurance company. No, Many, like food preparation, all of that. Many things are not acceptable to the insurance company. So that's a material change, is a change that alters the risk. Yes, it does alter the risk in a way that increases the potential for loss. Absolutely. So one of our customers, I always try to give you a practical example. I got a lot of feedback. Because I've been around the block for a while, so we've dealt with a lot of different things. So I got a lot of feedback saying that in the exam in Rebo, those who passed the exam, they always remembered this example that I provided. That's what they said. And it made sense. Immediately they said, oh, okay, I remember that example. So here for B, we had a customer and he made a fire loss. Okay, there was a significant fire that happened in his garage. So we, of course, sent the contractor out to investigate right away how the fire happened and everything. And immediately we found out within like a few minutes, he was actually running a welding shop in his garage. So we checked the file to see whether he called in. No, he never called in. Okay, so he just started a welding shop. He didn't know that he should call the insurance company, and he was making a lot of money, and something went wrong. Some cylinders were kept there, like a natural gas cylinder. They just exploded, okay? And the whole garage and part of the house was completely destroyed, right? So what he did was a material change. So of course, it altered the risk in a way that increased the potential for loss. Absolutely. Okay, so there's nothing untrue about this. B. So let's go to C. If the insured reports a material change, now you know what a material change is. Think about the welding shop he started in his garage. That's a good example, right? Think about it. So if the insured report the material change as soon as possible, ASAP, okay, as soon as possible, and additional premium is rarely charged. Oh, really? How come? You already said it's a material risk, material change that's significant. And when we allow a business to go on in the basement, customer call, oh, I'm just starting a small office and I'm an accountant, I'll be doing taxes. Okay, I say, okay, we're going to increase your liability because people are coming in the tax time and they could slip and fall. And also you need to purchase errors and omissions coverage. Okay, I don't want to digress too much here, okay? So that's a material change. We would have charged additional premium, of course. But here it says, if the insured report the material change as soon as possible, I mean, you shouldn't be sitting on it. And additional premium rarely charged. No, this is untrue. Okay, of course we will charge a premium because the risk is more. The risk exposure is more. So let's also take a look at the D. So when a loss arises directly out of an unreported material change, the insurer can deny the claim, which is true. Because we have a problem here, because the material change, something significant change made to the house, like starting a business, was unreported. So the customer has failed. He fell short of being a good customer. Okay. So the D is not untrue. Okay. This is true. So I'm going to go with C. The C is untrue. We will charge a premium. Okay. Okay. Next one. The basic fire policy. Oh, okay. Again, pay attention here. Okay. The basic fire policy. All right. For how many days? So in the basic fire policy, for how many days does the removal of insured property extension apply to remove property from an insured location to prevent further damage? Oh, they packed a lot of stuff here. Okay, let's just unpack it, okay? So first of all, we are talking about basic fire policy. Okay, number one. Number two, they are talking about removing the property from an insured location. Now, I may have talked about this before, but it's worth just mentioning very quickly. The insurance company, they insure your property in three places, in three situations. All your property that is kept in your main home, number one, that's the majority, okay? Then the property that you're taking when you're traveling anywhere in the world, they cover that. Number two. Number three, let's say you have a teenage son or daughter, and he or she is going to college or university away from home. And then he or she would have taken some furniture with her, guitar, computer, bed, whatever it is, okay? and then this person is living in a dorm. If something happened to the property there, yes, because that person is still a dependent on your family, not working, okay? So still a student. So we should cover his or her property. But then the one problem with that is the third one, the student property, there's a special limit. Most of the company that we are working with, including Intact, Aviva, Travel, big company, they cover, if I'm not mistaken, $2,000. That's it. Okay, just a quick aside. If the customer says, oh, you know what, my son has like 3 guitars and whatever it is, he's got a lot of stuff. You guys are only going to cover 2,000. That's not enough in the dorm. Okay, then, Mr. Customer, we would suggest that you just get a tenant's policy just in your son's name. Okay, a tenant's policy. Yeah. So suggest that like $15,000, $20,000, $30,000 worth of policies, like maybe $20, $25 a month. Okay. So anyway, coming back to here, the property is covered in 3 places: main home when you're traveling, and then the student property. Okay. Now we are talking about removing the property from your home. Okay. And we don't know where it's going. We're not traveling. We're not talking about a student. We don't know where you're taking this, but we are taking the property from your home because something happened to your home, a fire, water damage, whatever is happening. To prevent further damage, you are saving this property from this, okay, fire. Let's say fire is a good example, okay? You're salvaging the property, which is a good thing for the insurance company, so that they don't have to replace it. You saved it from destruction. So then, let's say you took maybe about $30,000 worth of property and they put it in your cousin's place, and there it's stolen from your cousin's place. Okay, so you're having a bad day here, right? Will that be covered? Yes. The answer is yes, but they're asking you for how many days. And you have to know this. You cannot just guess. And I know, I've been teaching the property for some time, 7 days. Okay, 7 days, or until the policy expires. Oh, what do we mean by that? Why they're throwing a curveball at you now? What do you mean until policy expires? Okay, here, let me explain. So let's say the customer's policy expires in 2 days. And he already told you, look, guys, I'm not going to renew my policy with you guys. I'm going with a different company. And the policy is expired. So today I'm recording this on 23rd of June, okay, 2023. And so the policy expired the 25th of June. And now today he had a big fire. And so you took about 30, 40,000 worth of stuff to his cousin's place. And so we are only going to cover either for 7 days, but in this case, no, we're not going to cover for 7 days. Why? Because the policy is going to expire in 2 days. And he already told us he's not renewing the policy. He's going with a different company. So that's why it says until the policy expires or 7 days. Make sense? Okay. So the A is definitely the right answer, but 8 days, 15 and 30, they are wrong. Why? Because we are talking about basic fire policy. The basic policy only gives 7 days. Okay. All right. So that's the answer is A. So question 27, which of the following does not apply to the statutory condition? Again, be careful. It says does not apply to the statutory conditions. Okay. So they're testing your knowledge in statutory conditions here. Okay. You need to know all the statutory conditions. I think I have one video, just 1 or 2 videos, just talking about statutory conditions. Okay. If the insured has a reasonable chance to protect the property from loss, but failed to do so, it would not affect the claim settlement. Oh, really? Why not? He had a chance, reasonable chance to protect the property, but then he failed to do so. It would affect the claim settlement. I know I have a lot of colleagues who are adjusters. I know friends who are adjusted in my class and everything. That's what they would tell you right away. This A is wrong statement. Okay, so anyway, let's keep reading on. When the insurer chooses to repair property, it must give written notice within 30 days of receiving the proof of loss. That is absolutely correct. Insurance company received the proof of loss from the customer with all the details of what was lost and destroyed, and they cannot just sit on it forever. They have 30 days to tell the customer what they're going to do. They're going to give them cash. They're going to replace the property, what they're going to do. Okay. So that is, yes, it is a statutory condition. C, an agent of the insured can give notice of proof or loss if the insured is unable. Okay, so who is the agent? So an agent, don't get this confused with an insurance agent, okay? An agent of the insured can give notice of proof of loss if the insured is unable. So what's happening here is what they're saying here in C, that a loss has happened in insured's home, but maybe he was hurt and he was taken to the hospital. So he's unable to give proof of loss form. Then he can authorize a friend, a relative, or somebody, that's what they call an agent, okay, like giving a power of attorney or something, and say, okay, you know what, I have to submit all these things to the insurance company, and there's a deadline, I don't want any trouble, okay, I'm here bedridden in the hospital, yeah, I give you this with my signature, a written note, like a power of attorney, can you give notice to the progress the claim? Yes. Yeah, statutory condition allows that. In fact, the name of the statutory condition is who may give notice. Okay, that's the title of the statutory condition. D, after loss has been reported, the insurer had the right of access to investigate the loss. That is correct. Okay, that this statutory title actually entry, control, and abandonment. Entry, control, and abandonment, that's the title of the statutory condition. That means the customer shouldn't play like hardball. Okay, oh, we don't have the time, we have to go for a vacation for a few days or something, or whatever, you can enter the house now. No, 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 you need to work with the insurance company. Okay, the contractor adjuster, especially the water damage, they have to get to work immediately, otherwise the mold will grow within 48 hours. The mold will grow and they will be responsible for it. They should be held responsible for it. So they'll come with all those big fans and everything, they set it up, and they run them 24/7 to dry the place up. So you have to give them access to investigate the loss, okay, and to start their work right away, especially water damage, okay, because once the mold start to grow, it's very difficult, if not impossible, to control it, okay. That's why the mold will grow like by millions of bacteria, right? Okay, so let's reread the question. Which of the following does not apply to a statutory condition? Okay, so I'm going to go with A, because it says that if the insurer has a reasonable chance to protect the property, but he just ignored it. He didn't do anything. The property was destroyed, but he could have saved some property. Can I give you an example? Okay. So we had a customer who had an accident in Sudbury. Sudbury is just a little bit up north, okay? So what happened was, it's an Audi SUV, high-end vehicle, fairly new. And so he had an accident. So he just uh, called a Uber, and he just came home and he called us to make a claim. And he said, "Hey guys, I had an accident, and it's there in car in Sudbury, and go and take care of it. So I want to make a claim." When we got there, all the wheels were gone. Even the airbag was removed from the car, and the stereo, and it's the Audi SUV. Okay, they removed a lot of stuff, okay, from the car. So the adjuster told the customer, look, we are having a problem with this. We're going to deny some of this claim because you had a chance to call us from there, or you could have somehow get it towed. You just abandoned it. You had a reasonable chance to protect the property, but you failed to do so. Okay, it would affect the claim settlement. It would. So A is the answer here, because it says which of the following does not apply to statutory condition. Okay, so I'm going to go with A. An insurance contract is only legally enforceable when it has 3 additional elements, and you should know this by memory, okay? So there are 5 elements for a regular contract. You should know that also by memory. I think I discussed in the last lecture. And then in addition to that, insurance contract, they are so unique, they should also have 3 additional elements. Which one of the following is not one of them? I hate this kind of questions, okay? They say they could have asked, okay, which one of the following is the additional element? Okay, but here they say which one of them is not one of them. So that means they put a little bit pressure here. You have to know the three elements, okay, definitively, because you have to pick the one which is not. Okay, so you have to memorize it. If you haven't memorized it, kind of get to work, okay? So I know them, so let me try. Insurable interest, yes, absolutely. It's one of the additional elements for, in the insurance contract. Utmost good faith, yes, because in the industry, in the insurance, I mentioned that a few minutes ago, that we rely on the customer, what they tell us on the phone. That means we are presupposing that the insurer is practicing utmost good faith, that he's telling the truth. This is very unique to this industry, right? So we have to rely on what the customer is saying, because we don't have the chance to go and inspect every home, every car. It's just not feasible. C is the fiduciary duty. I got a problem with that. Yes, fiduciary duty it's meant for us. Who's a fiduciary? A fiduciary is somebody, a person of trust. Why we are called persons of trust? Because even during COVID, we were people essential business insurance. Why? Because people, the public, they trust us. They keep on giving you the money month after month, year after year, and they're trusting us, saying that someday when they make a claim, we will be there to help them. Okay, and that's what we are called fiduciary. Yes, the C, there's nothing wrong with that, fiduciary, but it's not one of the additional three elements. That's the problem. Indemnity, absolutely. What the meaning of indemnity and why it is so unique to the insurance contract? Because we keep on receiving the money and we're making promise. We're not giving anything in return to the insured, but we're just making promise. We will indemnify you when something happens. So if you want to buy a car, you go and give them the money and you take the car home. But indemnity, when you buy insurance, you don't take anything home. You take home a bag full of promises on the premise of indemnity. That means it's in the future. If something happens, we will bring you back to the same financial position, no more or no less, and then all those things, right? This is very unique to the insurance contract. So I'm going to go with C, which is not one of them. Okay, fiduciary duty is not one of the three additional elements. 29, which of the following best reflect the duties of the broker? Again, my friends, when you read these questions, look at the word here. It says, which of the following best reflect? That means they are giving a heads up. Hey, there may be more than one answer here which look to be the correct answer, but you have to choose the best one. That's what it's saying, okay? A broker acts only in the best interest of the client. Yeah, I will go with that. Why? Because a broker, by definition, he's working with the clients mostly, okay? And then he's working maybe with the 10 different insurance company. He's going to do a quote with many companies, but he's working with the clients mostly. Okay, so I would go, there's nothing wrong with that. Okay, but it's asking for the best. So that means we have to read all the answers. A broker must always try to place insurance with the cheapest insurer. Okay, nothing wrong with that. Okay, I mean, price is not always should be the criteria. You should also look at the coverage, but I'm okay with that B. The insurance companies, they should go with the cheapest insurer. If the coverage the insurer is asking is all available with this insurance company and this is also cheapest, hey, why not? Okay. C, a broker does not owe any duty to the insurer he or she represents. It's not exactly true. I mean, you do have a duty to disclose everything the customer told you and everything. But again, the broker's definition is that he's mainly working with the public, with the customers. So he does not owe any duty to the insurer he represents. That means the insurance company cannot tell them, hey, okay, I want you to bring this much business to me. They cannot kind of demand, okay, or ask him to do something. Okay, because broker is very independent. Okay, so it's okay. It's not a wrong answer, but it's not the best reflection of the duties of the broker. Okay. So the D, that's the only thing we have left here. Hopefully it's the correct one. A broker must always be truthful and disclose all material facts about the client's risk to the insurer. Absolutely. I could not have said this any better. This is probably the best reflection of the duties of the broker. You see, my friend, you have to read all the choices, and this is the slam dunk D. A broker must always be truthful and disclose all material facts, important facts about the client's risk to the insurer. You know, there are many brokers that I know, they don't, for whatever reason, they want to get the risk and they don't disclose everything. And then later on, when a loss happens, then they get into trouble. Okay. So I'm going to go with without a hesitation, D, because that nicely sums up in one sentence what a broker should be. What's the role of the broker in the insurance process? Okay, now they're talking about the process, the broker's role. So it says an intermediary between the client and the insurer. That's absolutely correct. This, in fact, is a textbook definition. The broker is like a conduit, like an intermediary in between person between the client and the insurance company. There's nothing wrong with that. Okay. So B, an intermediary between the client, the insurer, and the regulators. No, that's wrong. The broker, they don't deal with the regulators. No. C, an intermediary between the client, insurer, and REBO. No, that's also wrong. And none of the above. No, I'm going to go with A because that's definitely true. Intermediary between the client and the insurer. Okay. So answer A. The law requires that brokers exercise reasonable skill, care, and diligence. Otherwise, errors and omissions claims may arise. That's absolutely correct. So the main reason for E&O claim is, so the main reason I'll tell you from my own experience, I was actually rolling out a REBO CE credit training because in my brokerage, we have more than 400 brokers and they were struggling to get the CE hours, continuing education hour. We have to have 8 hours in I'm talking about Ontario. REBO is Ontario. And so some of them, they have their license even suspended because they forgot about it or whatever. So since many years now, I started my own REBO courses. So over the years now, I've developed so far about, I think, like 55 to 60 courses, and I sent all of them to REBO, to regulators. They actually approved every one of them. So what I do is, including ethics, is a mandatory 1 hour, okay, and technical personal hours and everything. I developed all kinds of presentations and they approved everything. So I just give them the course every year and I give them the 8 hours to all my brokers. They are fully authenticated by REBO, all those hours, right? So yesterday I was doing the 1 hour personal CE hour for a group. And one thing I told them is that, guys, when I audit the files, I noticed a lot of mistakes because you're not talking enough to the clients, because we are having complaints and errors because you haven't asked all the questions. You go to a business, you have to take your time. You have to ask a lot of questions depending on what they're doing in the business. And you're missing out, you're rushing. And so what you're doing is you're not identifying all the loss exposures. This is the main reason we see all the articles by industry regulators and everything. This is the main reason for E&O claims, because the brokers are not asking enough questions and not finding out what the clients are exposed to, all the risk exposures. Okay, so I just wrote this one sentence for you guys. Failing to identify clients' loss exposures and failing to and offering inadequate coverage. Oh, that one should be inadequate. Give me 1 second, okay? Let me read this again. Failing to identify clients' loss exposures and offering adequate coverage. Oh yeah, I think that's okay. I think I wrote it correctly. Okay, but the main point here is that failing to identify. I was telling them the same thing, because that's why we have complaints and we have gaps in coverages, because you're not talking to them enough. Okay, you're rushing your client. Okay, next one. The primary function, very important. The primary function of an underwriter is to do what? Okay, it's a good question, really. There could be definitely more than one answer, but what the primary? Check the physical hazards of the risk. Yeah, there's nothing wrong with that. Okay, so underwriter, they have to do that, physical hazards. And so check the moral hazards, like financial situation of the client, right? Losses he had in the past years. All those could be moral hazards. Yeah, they do check that. Let's also read the next two. Check the financial status of the applicant. Yeah, that's true. Okay. And then D, select risks that are most likely to be profitable for the insurer. That's a beautiful sentence. This is definitely one of the mandates of the underwriter, is to select the risk. That means don't just accept all kinds of risk. Okay, select the risk according to the underwriting manual, the rules set by the company, so that the insurance company is not going to get into claims after claims and payment after payment, and they're not making enough money, and one day they close down the business. So what's the point, right? So underwriters have to be very careful in selecting the risks that are presented to them by brokers. Again, they shouldn't be rushing. They should cross all the T's and dot all the I's, the underwriters, and their job is tough. I know that, okay? But they have to take their time and see if the broker has provided all the information and there is nothing ambiguous or nothing missing, okay? Because they don't want to put the insurance company in a situation of a loss, okay? So they have to be very careful when selecting the risk. So I'm definitely going with D. Okay, nothing wrong with the other ones. But then look at the question. The primary function is D. No question about that. Okay. When an underwriter looks at the financial and claims history of the applicant, they are looking for which of the following. So I just said in the previous question, when the underwriter is looking for, like, it's not a physical hazard. Okay, this is like a moral hazard. They're looking at the financial condition. Why is he borrowing so much money from the bank? Why did he sell some assets just a couple of years ago? Why is he withdrawing money from his surplus? Why did the rating agency downgrade his rating, like AM Best and Fitch and Moody's and Standard and Poor's? Why did they downgrade his rating? Okay, so that's financial. So that could be a moral hazard, right? Maybe he's in a bad financial situation, and these are the potential candidates who will make a claim, who will maybe set the building on fire, and they'll make a claim. Oh, I'm in a good mood today. I'm so sorry. I'm not saying that people are so bad, but I'm just giving you like a metaphor. Okay, like metaphorically speaking, he may, if he's in a bad financial situation, people have done that, like arson, right? Okay, come on, just slow down or chill out a little bit. And claims history of the applicant. Has he been making a lot of fire claims? Let's get back to the fire again, okay? Why? What kind of fire? The whole building is gone? Oh, he made another claim last year and the year before. This is a moral hazard. Okay. Oh, you guys already have the answer for me there. Moral hazard. B. So risk tolerance of insured? No. Risk tolerance, how much he wants to retain for himself and how much he wants to transfer to the insurance company. What does he think about, insurance, so on and so forth? I mean, you can have a whole lecture on risk tolerance. Moral hazard, yes. I kind of teach this, moral hazard, okay? Financial claim history is definitely two of the attributes that goes into moral hazard. Physical hazard, no. Nothing to do with the financial claim history. Compliance to regulation hazard, that's not exactly a moral hazard. That would be like a negligence or is dropping the ball while compliance, it's not a moral hazard. Okay, you didn't comply to some regulation like a PIPEDA or something. Okay, but the moral hazard is more serious than that because it's a human element. You don't know whether he's telling you the truth or not. Okay, that's a moral hazard in a nutshell. It's a human element, and it's just the behavior of the person, whether they're lying or telling the truth. It's very difficult to find out. That's why insurance company will dig into the financial situation in the last 5 years, what's going on with the financial situation, and the claims history will tell them a lot about the person. Okay, so I'm going to go with B. It is often said that property insurance policies are designed to insure against direct damage only. Okay, I have to I have to pause right there. And before we read it looks like a long question. Before we read the rest, let me define the direct damage, okay? So the direct damage is, I'll give you an example of fire, water damage, windstorm, theft, those kind of things, okay? These are directly affecting the property, like a break-in, we have fire damage, okay? So insurance company will pay for those. That's why you have insurance for direct damage, okay? And so yesterday, a fire destroys 65% of your client's apartment building. So from my definition, it is a direct damage, okay? Fire destroyed a building. Yeah, it's a direct damage. What is likely not covered in this situation? Oh, these questions are tough, okay? So what is likely not covered in this situation? So what they're talking about is, that's what they asked you, do you know what a direct damage is? Okay. And they also want to know whether you know indirect damages. Okay. I think it's did some videos a long time ago. Not long time ago, maybe a couple of months ago on CAIB-1 on direct indirect damages. I don't really remember. But the opposite of direct damage is called indirect damage. Okay. How about some examples of indirect damage? What are they? Let's say you owned a restaurant and then you had a fire. Okay. Oh, yeah, actually here, apartment building. You own the apartment building and yesterday you had a fire. So the direct damage is the fire loss. You make a claim. They're going to send out a contractor to estimate what the destruction, how long it's going to take, and they're going to fix it. You can make a claim. Okay. But then because of the fire to the apartment building, a number of things are happening. Your tenants are leaving. You may even have a lawsuit. You're losing income, okay, rental income. And it's going to take time to get new clients and to repair the stuff and all of that. So as a consequence of the fire, a number of things are happening, okay? Like loss of income, loss of rental income is a big one in an apartment, right? Those are called indirect damage. They're also called in some books consequential damages because they happen as a consequence of the direct damage. Those are not covered under your property policy. No, the property policy will only cover you for direct damage, water damage, fire, windstorm, lightning, explosion, all of those things. A tree fell on the roof or something. Yes, it's all direct damage. It'll be covered. But as a consequence, something happens, okay, that's not going to be covered. Then you're asking me, so how can I get, if I'm losing rental income, it's going to be thousands of dollars. Okay, so there's for businesses, you can actually go and get the business interruption coverage. For rental income, you have to have separate coverage for that. You can have rental income coverage, okay, but that's not going to be covered by a property policy. It's a separate. It could be an endorsement, it could be a new policy, whatever. That's why I wanted to use the restaurant as a good example. The fire destroyed a restaurant, and now you're losing customers, you're losing income. Okay, all these are happening. For those, you need to have business interruption coverage. Okay, with that explanation, let's reread the question here. So it says, what is likely not covered? So now you have the answer. Any indirect damage is not going to be covered. Okay, now let's see what options we have here. Smoke damage to the building. Direct or indirect? Oh, I'm sorry. Yeah, I'm recording a YouTube video. I'm not going to get a response, right? This is like I'm standing in front of an audience. I'm asking them question. Okay, so I'm making a video. So smoke damage is a direct damage. Okay, because fire, smoke, they all happen together. Okay. Additional living expense incurred by the insured. Okay, additional expense incurred by the insured. So this is already covered by the policy. So let's say they have to go and stay in a hotel or something. Okay, that is a part of the policy. Actually, coverage D. If you're in a home, you had a fire, you can actually go check into, make a claim, and they'll say, okay, we have to put you in a hotel. Okay, that is actually coverage D, like Delta on the property policy. Okay, it's covered. Fire damage to the building, of course, it's covered. It's a direct damage. So D is a loss of rental income. There you go. Because of the fire, as a consequence of the fire, the apartment building owner, they're losing rental income. That is not covered. They have to have some kind of business interruption coverage or, rental income coverage. It's not covered in the property policy. So what is likely not covered in the situation? I'm going to go with D. D like David, okay? What is the main benefit of a mortgage clause for the mortgagee? So first of all, who is the mortgagee? Is the bank. Mortgagor, GOR, is the person who borrowed the mortgage, like the customer who bought the house. But the mortgagee is the bank. So among the following, what is the main benefit? Okay, let's go through that. Entitle the bank to a larger share of the proceeds if there is a total loss. No. Why? If it's a total loss of the house, the insurance company is only obligated to write a check to the mortgagee for the amount that the insured still owes. Why would they get a larger share? So that's wrong. B, prevent the insurer from terminating a policy mid-term. No, it doesn't make any sense. Prevent the insurer from terminating if the insurance company wants to terminate a policy mid-term for whatever material reason, okay, the customer didn't inform the insurer, whatever happened, yes, they have the right to do so. Nothing to do with the mortgagee. C, the policy will cover the mortgagee even if the insurer has breached a condition of the policy. Oh, what is that all about? So the policy will cover the mortgagee. That means they're going to pay them the mortgage the customer still owes, even if the insurer has breached a condition of the policy. Now, this may come to you as a surprise, and you say, oh, no, that's not possible. What if the customer set fire to his own house? He committed arson. That means he breached a condition of the policy. And we still have to write a check to the mortgagee. We can just deny the claim. But my friends, if you didn't know this, the banks are so powerful. Okay. They had this clause put in the property policy. Would you believe that? No matter what the insured did, he committed fraud, he set fire to his own house, he breached a condition of the policy, whatever he did, the mortgagee has to be paid. If you don't trust me, I don't know where you can go. Go to your own coach and check with them. This guy, maybe he's a crazy guy on the YouTube and he's saying, even if the customer breached a condition, the mortgagee has to be paid. That just preposterous. What do you call it? It's unbelievable. Okay. And you check it out. Okay. And you make a comment. But I'm going to go with C. Okay. But I know I'm right. I'm just kidding. Okay. I'm not always right, but I know C is right. Okay. My friends, the banks, that's why if you go downtown Toronto, for example, on Bay Street, right? And you just look up those buildings, what are those tallest buildings that you see there? Banks. They are so powerful. And yes, they were able to insert this clause into, this is called a standard mortgage clause, okay? And it's all in the property policy. You can read it. Take out your property policy, go to the standard mortgage clause. You should do that from time to time. You should take your policy and read some of the sections, not just, listening to some crazy guy on YouTube video. That's not going to be sufficient for your CAIB, okay? You should go through all the clauses in your own policy, okay? D, entitle the bank to cancel the policy at any time and get a pro rata refund. No, the bank cannot cancel the policy at any time. No, that's not the purpose of the mortgage clause. No. So without a doubt, I'm going to go with C for question number 35, okay? A homeowner losing the ability to continue to rent his or her basement suite after fire is an example of what? Okay. So a homeowner losing ability to continue to rent his or her basement suite after fire loss. So we're not talking here about a direct loss, okay? It says they're losing the ability to continue because of a fire loss. Okay, that means as a consequence of the fire, they're losing the ability. Okay, that is not a direct loss. The fire is a direct loss. And as a consequence, they're losing the ability to continue to rent means it's an indirect loss. Okay, so I know we actually talked about it just a few minutes ago. So what is it called? So the incidental loss, no, we don't have something like that. Direct loss, yes. So there's a fire. Okay, so we already said that in the question. But then something is happening after the fire. After the fire, what's happening? Losing the ability to continue. That means they're losing income. They're losing their tenants. Okay, that is an indirect loss. Okay, so it's an example. The fact that they're losing the ability to continue, that's an example of an indirect loss. So I'm going to go with C. Okay, liability, no. So when it comes to liability, it's all about a third party. The question doesn't talk about any third party was injured and now they're suing the client. No, that would be liability. Okay, the question doesn't say anything about that. Okay, so answer is C. Which of the following policy provisions is used to restrict coverage specifically regarding the use, condition, or maintenance of the insured property? Okay, what they're talking about here. Sometimes the property is not completely acceptable to the insurance company. Let me give an example, okay? We had a jewelry store downtown Toronto, and we were very interested because they were willing to pay any premium. It's a huge, like a diamond store and everything, okay? High end, okay. So we want to get that business. The broker brought the business, and then underwriter and the risk manager went there, and they said, look, we are willing to take up this, okay? We're willing to provide you, but on certain conditions. So one of the conditions was they have to replace their security system. We were not happy with that. Our risk management manager was not happy with that. So risk manager actually proposed or suggested he actually suggested two companies, two high-end burglar protection system, okay? And they talked about it and they said, okay, they agreed to go with one of those, okay? They said, it's good for you and good for the insurance and we'll give you coverage. And we also told them to have a maintenance contract with this company, the security system company, okay? This is remotely controlled, central office monitored, the whole works, high end. Because we are talking millions of dollars worth of jewelry in the store, okay? And they agreed. They said, okay, this is a practical thing and it's going to cost us more money, a lot more money than what we have now, but we're going to have it. Okay, so we gave them the policy. So this happened like a few years ago. So after some time, there was a claim. There was a break-in. There was a significant claim, okay, of theft of jewelry and everything. So of course, whenever there's a theft claim, our SIU department, like a special investigation unit, they'll jump on it immediately to make sure there's no fraud, and collect the evidence. Okay. So they went there to the place and they checked everything, and they checked the security system, and the security system part of that was not working. And also they checked the file, what kind of security system that they should have had. These people working in our company with the risk management professional SIU, they are like forensic experts. Okay, some of them like retired RCMP officers, from law enforcement. They have all these tools to do their work. Okay, and they check the notes on the application, and so the security system is different, not the one which was suggested by us. So then the big question, so what's the discrepancy here? We found out, make a long story short, the manager now is different after a year or so. Okay. So the new manager is all about cutting down the cost. So what he did, he changed the security system, okay, to the previous one, because he noted that they're paying a lot more now. And then he also canceled the maintenance contract. So when the theft happened, the security system, didn't work properly for one thing, because there was no maintenance, and then it's the older one. So here, what they did basically, what I'm explaining here, this is called a warranty. So a warranty is given by the customer, in this case, the jewelry store, to the insurance company, that they will maintain something or they will install something according to the recommendation of the insurance company, and they will maintain it. That's the warranty given by this jewelry store to our insurance company. And what they did, they completely breached that warranty. Okay, so let's just go back to the question. Which of the following policy provisions is used to restrict coverage, specifically regarding the use, condition, or maintenance of the insured property? Okay, by imposing a warranty. So an endorsement is a change you make to the policy. There's nothing to do with the question. It's a change, it's an endorsement. Co-insurance clause, no, it's a penalty for underinsuring your property. That's it. Okay, it's a clause that penalizes the customer for underinsuring their property. Actual cash value, no. It's just a method of claim settlement. Actual cash value is that how much is the stuff worth minus depreciation, right? So actual cash value. So I'm going to go with A, okay, because that is exactly the answer for the question. Next. Identify the doctrine that stipulates that if a loss to property is attributable, that means the loss, the loss was responsible. Okay, I mean, what was responsible for the loss, to more than one cause occurring simultaneously, and one of which is covered by the insurance policy, the loss is payable under the policy. It's a tough question. Okay, so let's just go back to the question, read one more time. Okay, identify the doctrine that stipulates that if a loss to property is attributable to more than one cause. Let's stop right there. So let's say there's a windstorm going through in your area, and then it knocks a tree down on your roof. Okay, so now we have one loss, which is windstorm. And now a rain follows right after the windstorm, okay? And so the tree fell on the roof, and then it caused a big damage to the roof, and kind of it made an opening in the roof. The roof is now kind of open, okay, because of the tree. And so the rain followed, and then now you have a lot of water came in because the roof is damaged. So now you have two damages going on here. One is windstorm, another one is water damage. So if a loss to the property is attributable to more than one cause, so go back to my example, water damage and windstorm occurring simultaneously. Yes, it happens simultaneously. Okay, anyone of the any one of which is covered by the insurance policy. So windstorm and water damage is covered. Okay, both of them are covered in the policy. So this situation in the insurance industry is called a concurrent causation. I know the answer to that, okay? Concurrent. We use this a lot because two things are happening at the same time. Okay, and both are covered in the policy. So it's called a concurrent causation. That is the doctrine that we use, okay? Proximate cause is just what caused the loss. What were the main cause that the proximate cause, okay? Remote cause is something that affected that led to the cause, okay? Not the exact proximate cause, okay? There's something remote. Somebody was kind of remotely involved in this, in causing the loss, okay? You can't directly hold them responsible because it's a remote cause. Fortuitous, the word fortuitous we use in the industry to mean sudden and accidental. Not something happened over time, okay, but something happened suddenly and accidentally, that's called fortuitous, okay? And also by chance, something that you didn't expect to happen. Let's say you don't maintain something and you know after a while it's going to break down. That's not fortuitous, okay, because the lack of maintenance, it broke down. You kind of expected it. But fortuitous is something that happened by chance without you expecting it, okay? So I would go with the concurrent causation. That is the doctrine when two things are happening, okay? Answer A. Couple more questions. What type of mortgage conveys an interest in property other than land and buildings as security for a debt? So there are two types of mortgages. One is for land and buildings. It's just called a mortgage, okay? It's called, yeah, it's just, standard mortgage. Usually it refers to buildings and land, but it's asking about other than building and land security for a debt. So I know the answer to this. This is called chattel mortgage. Chattel mortgage is for, like, for example, a machinery. You can mortgage a machinery and get a loan. You can use that as a collateral. So that would be called a chattel mortgage. Any like a movable property, mortgage on that movable property will be called chattel mortgage. But the land and buildings, they're, kind of fixed assets. So that's just a regular mortgage, right? Full mortgage, multifaceted mortgage, and unrestricted mortgage, no, all of that is wrong. Okay. Chattel mortgage is definitely, you must have heard about it. Okay. So that's A. And the last question for today, policy wording that does not conform to the standard wording. Why? Why would that be? It does not conform to the standard wording because the risk we are dealing with is so complex that we have to sit down with our lawyers and we have to write down special wording. And we have risks like that, like, offshore oil rig and, things like that, right? So just the standard wording is not going to be sufficient, okay? So we have to word special wording in general use within the insurance industry, and that is unique to the policy involved. Like I said, the complex risk, we are writing nuanced wording, okay, with the legal wording, legal counsel and everything. What do we call that? That kind of wording? Special wording? No. They may be special, but that's not the word that we use in the industry. Manuscript wording, yeah, that is correct. That is exactly the answer. Manuscript wording. And special underwriting wording, no. Endorsement wording, no. We don't use those. But definitely, you should be familiar with this. Manuscript wording means a special wording that do not conform to the standard wording in the policy because the risk is so complex, okay? So I'm going to go with B. So my friends, hopefully that helped you a little, okay, with the definitions and everything. And I have a lot of feedback from you guys, for the YouTubers, that the question discussion, like what we're doing, it really helps you to understand not only which is the right answer, why the other answers are wrong, but not to say that then all the answers that I gave you, they are correct. You have to check your material, your textbook, and just be, you should be convinced yourself, okay, I see that this seems to be the right answer. I agree with this guy, okay? All right, my friends. So thank you for your time, and I will see you in my next video.